Well, hi everyone, and welcome to the Buffett and Beyond Stock Analysis video podcast. And this is with your host, Dr. Joseph Belmonte, which is me, and Debbie with the Y. Hi, Debbie. How are you doing?
Hey, which is me. I'm fine, thank you, JB.
And this is based on the book Buffett and Beyond, second edition, published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. And just to remind you, especially you new folks just watching this for the first time, is that we use a return on equity that is called clean surplus. And folks, this is different than the traditional accounting ROE. The clean surplus, which means we are cleaning up the surplus, which are earnings, is a comparable model. And think of your bank account. An account with a higher return, your interest, which is really your return on your money, your return on equity, will earn more than an account earning a lower interest or a lower return on equity. And therefore, we want to construct portfolios that are made up of stocks with high clean surplus ROEs because they outperform other portfolios of stocks made up with lower clean surplus ROEs. Just think about your bank account. You will get more money or earn more money over the years if you are getting a higher interest rate. And let's get right into it because we're going over some airline stocks which were requested by several of you out there. So Debbie, what's our first stock of the day?
Well, hello, JB. Hello, everyone. Our first stock of the day is Southwest Airlines and stock symbol LUV, L-U-V. And Southwest Airlines is one of the largest carriers in the United States by revenues and the largest by passengers flown, specializes in low fares and short hauls, uses point-to-point versus common hub and spoke model. They acquired AirTran 511. At the end of last year, they served 100-plus destinations, operated a fleet of 706 aircraft, 125 of those which were leased, on order 287 additional aircraft with option for 191 more.
That's a lot of planes.
That's a lot of planes. And they have a lot of employees, too, at approximately 55,700.
Okay, let's see that all sounds nice, folks. Well, let's look at the numbers. And the first thing we want to look is that clean surplus return on equity. And folks, to get in our growth portfolio, we want to see stocks that have a clean surplus return on equity of 20% or more. And boy, oh boy, this stock is doing it over the past couple of years. And going into 2019, just about 19.4%. However, these numbers look good, but let us go back to 2012, 2011, and I want to show you some pretty low numbers down in here. So the first thing we have to remember about airline stocks is they are cyclical, and we don't care for cyclical stocks. In other words, when we get into a recession, these stocks go way down, just like some of those planes. They just land them and they don't take off again for a while. And then we have to worry about the cost of fuel oil all the time, or jet fuel, I should say. And so we have two things that work on them in adverse ways sometimes. When the economy is good, these stocks are going to do good. When the economy's not so good, like back down in here, folks, people were not flying as much, and you can see that these returns were very, very paltry indeed. So just remember that this has a nice high ROE because times are good. And when we look at debt, the years to pay debt, that means if they took all of their earnings and used it just to pay debt, how many years would it take? And Buffett's rule of thumb is 5 years or less, and this company can pay it off in 1.3 years. So that's pretty good. So let's look at the returns and see how this stock has done over the past year. And here we are. This black line is the S&P 500 index, and this rusty colored line is Southwest Air. And right in the beginning of the year, or the beginning of the past 12 months, it was doing very, very good, and then it just had a downturn, recouped, and now is all the way down again. So this stock is down about 7%, while the market is up about 6% over the past 12 months. And when we look over the past 5 years, it has done very, very well, gaining about 175% while the market is up about 50%. So 3 times the market, but it's quite volatile, as you can see by the 1-year return. And just looking at this right in here, this is very, very volatile. So we have to worry about these airline stocks and the volatility of them. Okay, Debbie, what's our very next stock so we can have an comparison here between the airline stocks.
Alrighty, JB. That's American Airlines, stock symbol AAL. American Airlines Group, formerly known as AMR Corporation.
Young folks, I just want to tell you that Debbie calls this American Scarelines, not American Airlines.
I didn't want to frighten the folks, JB. They can trace its roots back to 1934, and the company operates two airlines, American and U.S. Airways. That's the one I call U.S. Scareways. Its combined fleet encompasses approximately 950 aircraft and operates on average 6,600 daily flights to destinations within 54 countries. American Airlines is also one of the world's largest transporters of cargo with facilities and interline connections around the globe. The corporation emerged from Chapter 11 bankruptcy protection in December of 13.
Let's look at the numbers. And the first thing we want to look at is the clean surplus return on equity. And folks, the average stock in the S&P 500 has a clean surplus return on equity of about 14.5%. So this stock is a little bit better than average, but you can see back here, just after it came out of bankruptcy, these numbers were all over the place. And folks, when you see 80%, you say, wow, that's really high, but it means nothing. It means that the earnings just went from 20 cents to 40 cents, so that's almost 100% increase. So we don't look at those numbers. Those are outliers. So we're looking at the last 3 years and going into 2019, and we can see that this is an average stock. The problem is this company has a lot of debt with 9.1 years to pay debt, with Buffett's rule of thumb 5 years or less, and our rule of thumb is about 3 years or less. Folks, we don't like a company that has this kind of debt, that especially a cyclical stock, which if we go into a recession or even the threat of recession, this company may not be able to pay back its debt, and we might be talking about bankruptcy once again. So we don't like this debt at all. And looking at the past year of returns, we can see the S&P 500, this black line, with an increase of about 7%, with this stock negative 25%. So folks, the market does not like that high debt load either. And when we look at the past 5 years, we can see this company's up about 40%, with the market up about 50%. So it's underperforming the market. And folks, if you want to get into a stock that's underperforming the market, you may as well buy the market, or the S&P 500 or the Dow 30. So let's get to our next stock. And Debbie, what do we have?
Alrighty, JB. Up next is Delta Airlines, and their stock symbol is DAL. And Delta Airlines Incorporated is a major international airline with 10 airport hubs. Provides service to every major domestic and international market. The revenue mix in 2017 consisted of the following: passenger 84%, cargo 2%, and other was 14%. Revenues by geographic region: United States at 71%, Atlantic 15%, and Pacific 7%, Latin America 7%, and the fleet at the end of last year, 856 aircraft. 664 were owned and 192 leased. It sure is. They're flying. They acquired Northwest Airlines in 10 of 08. Has approximately 86,500 employees, and Berkshire Hathaway owns 7.6% of common stock.
Yeah, we had to throw that in there because of Berkshire Hathaway. And folks, let us look at the returns of this stock. And we can see that clean surplus ROE is below the average stock over these past couple of years here and going into 2019. Remember that the average stock in the S&P 500 has an ROE of 14.5%. So the debt is okay. It's got a nice dividend. But when we look at this clean surplus ROE, we might as well buy the index. We don't care for this at all. And looking at the past 1 year, black line, again, the S&P 500, this stock is above the S&P 500 by about 3 percentage points for the past 1 year, which is not exciting me at all, folks. And then over the past 5 years, we can see this stock is actually up nicely, about 2.5 times that of the S&P 500. So again, we're looking at a stock that should not be outperforming the S&P 500. It is, but the numbers are saying be careful here. And let us look at these stocks together. So now we're looking at the S&P 500 ROE of 14.5%, Southwest Air of 19.4%. We're looking at 2019 numbers, projected numbers. American with 15.6% ROE, and Delta following the pack. So the only stock of this group that we would look at is Southwest Air. And please, folks, remember that these are cyclical stocks, and I don't like to put cyclical stocks in a portfolio at all. But let's look how these stocks have performed over the past 5 years. We would expect Southwest Air to be the leader, and American and Delta to be following, and maybe keeping up with the S&P 500. So looking at the past 5 years, we can see that LUV, or Southwest Air, is up about 180%, while the market is up 50%. And the blue line is Delta Air, up a little over 100%, which is actually doing very, very nice. But American Airlines has faltered over this past year, and we can see this rusty-colored line underperforming the S&P 500. So again, out of all of these, the only one that we would want to look at is Southwest Air, and we have to remember that it is a cyclical stock, and therefore it does very, very good when the economy is going good, but at the first hit of recession, this stock will drop like a rock, and therefore we don't like to put a cyclical stock in our portfolio.
Well, JB, I think we've just about covered all of the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, don't forget, if you want to receive a free full month of all our letters and complete access to our computer program, just go to our site and sign up. And remember that all you need to manage your own portfolio, and it's free. So just go to BuffettandBeyond.com. And Buffett is spelled with 2 F's and 2 T's, and I know some of you have trouble with that. But Buffett is spelled with 2 F's and 2 T's. That's BuffettandBeyond.com. Okay, folks, we had a great day today.
And tomorrow will be even better.
Okay, bye, folks. We'll see you next time.
Bye, everyone.